Good afternoon. Vice Chair Jefferson, President Emeritus Soller, Director Mahoney, and distinguished guests. Welcome to this afternoon's program. Director Mahoney will have the honor of introducing Vice Chair Jefferson to you all. So it's my honor of introducing you all to Vice Chair Jefferson. My name is Kimathi Marangu, and I'm a fellow at Stanford Law School's Rock Center for Corporate Governance. The Rock Center is a co-sponsor of today's event and is led by Associate Dean Adam Sterling. It's a community of corporate directors from S&P 500 and private companies who engage with practitioners, academics, and policymakers in important conversations like this. Philip, as you know, I've been on campus this year on a sabbatical as part of the Distinguished Careers Institute. And my cohort included global executives who have worked in G7, G20, and emerging economies, including Colombia, UK, Germany, Italy, Australia, Brazil, Switzerland, and more. It's almost like the World Cup, except for Italy. My cohort is represented here, as is Director Sarah Singer and Co-Director and President Emeritus Soller. We are here at SIEPR's home. Although listed as a co-sponsor, SIEPR is the first among equals. It's their venue, it's their menu, and their staff has done a terrific job bringing this event to life. We are grateful to Erica, Eric, Colleen, Michael, and the whole team for their work. Now, when you hear VC, most of you think venture capital, and some of you might think vice chair. A few of us in this room think Vassar College. And I've had the privilege of following in Philip's footsteps as an econ major, as an alum, and as a trustee. Now, good econ majors know the limits of extrapolation, so please don't put any bets on prediction markets regarding my future. So those are the groups represented here, Mr. Vice Chair. As I invite Neale to the stage, and he has been SIEPR's director since January 2025, I wanted to highlight two pieces of research that showcase his talent. The first was research he did with an unnamed payment company network data that showed that we are sleepwalking with subscriptions we don't need and subscriptions we don't use. It actually earned him a guest spot on Freakonomics. More recently, and relevant to today's talk, Neale and his team accurately calculated that the consumer gains from the recent tax bill would be consumed to pay for higher gas at the pump. And he did this within days after the price shock began. And it's this kind of curiosity, academic rigor, and applicable knowledge that I value so much in him. So, with that, Director Neale Mahoney.
Thank you so much for the kind words and for helping us bring the vice chair here to Stanford. I'm Neale Mahoney. I'm the director of the Stanford Institute for Economic Policy Research. It is my distinct honor to welcome Vice Chair Philip Jefferson to be with us this afternoon. Philip has had a distinctive career spanning teaching and research, university administration, and multiple stints at the Fed. He earned his PhD in economics from the University of Virginia. He began his career as an economist on the Fed Board of Governors. He then spent over 2 decades as a professor at Swarthmore College, where he was a renowned teacher and conducted important research on poverty, macroeconomics, and their connection. From there, he became vice president for academic affairs and dean of the faculty, provost, at Davidson College. He joined the Fed in 2022 and became vice chair in 2023. As some of you know, Swarthmore is a powerhouse for producing students who go on to get PhDs and enter the profession. And a number of my very good friends were Swarthmore undergrads and took Philip's honors econometrics class. So I couldn't resist the opportunity to start an email thread and ask them what they remembered about sitting in Philip's classroom. They shared many memories, some of which I will share with all of you. First, they said the class was not easy. You were not one to give partial credit for bad answers. Second, they said they had a lot of fun. They remember your amazing laugh and everyone laughing a lot, which is not my experience with undergrad econometrics, I'll tell you that. And third, and most important, they made it very clear, you made it very clear, that your students had to spell your first name correctly, which is with only one I. So Philip, you and I have something in common. We have one L. I'm very sorry. So I already screwed it up. And I'm glad, true to form, you called me out. So we have something in common. We have names that are pronounced normally and spelled unusually. You have one fewer letter than most people would expect. I have an extra E at the end of my name, which throws people off. So in true Fed form, jointly we are balanced, having in aggregate the right number of letters in our name. So we are delighted to have you here with us, and I'm looking forward to your remarks and our conversation.
Good afternoon, everyone. And I want to thank Neale and Kimathi for those wonderful and kind introductions. I am delighted to be here at Stanford University today to discuss a topic that is central to the Federal Reserve's work, and that is how policymakers analyze and respond to economic shocks in real time. The economy is constantly experiencing shocks that change economic conditions and that policymakers must consider. Today, I will focus on shocks that are extremely difficult, if not impossible, to predict, such as the emergence of a pandemic, the start of a war, or a sudden breakthrough in technological advancement. When such shocks occur, the Federal Open Market Committee evaluates them and sets monetary policy consistent with its dual mandate of maximum employment and price stability. This responsibility is both crucial and complex. Since the effects of shocks are uncertain in real time, policymakers must draw conclusions about their nature based on an analysis of the data, rigorous economic modeling, and careful judgment. Economic conditions also often reflect the effects of overlapping shocks, whose relative importance and interaction must be assessed. Today, I will start by classifying economic shocks and then discuss how monetary policymakers might respond to different types of shocks. Then, I will discuss how I am approaching the two significant developments affecting the current juncture: the energy price shock and the macroeconomic effects of artificial intelligence. I will talk about how both might affect monetary policy going forward before taking your questions. One simple yet effective conceptual framework policymakers can use to classify shocks is to determine whether or not their initial effect is on the demand side or the supply side of the economy. The demand side of the economy comprises households' consumption, business investment, government expenditures, and net exports. Demand shocks initially changed these expenditures without directly affecting the economy's underlying productive capacity. The supply side of the economy encompasses the structure of its production processes and markets. Supply shocks tend to affect the economy's productive capacity, often referred to as potential output. Productive capacity captures the available supply of labor and capital, as well as the productivity of those inputs. Potential output is the hypothetical level of production that an economy can sustain over the long run while maintaining price stability and maximum employment. Both demand and supply shocks can vary in duration. They may be temporary, causing short-term fluctuations, or they may be persistent, leading to more enduring changes in the economy. The nature and duration of these shocks significantly influence the approach to monetary policy making, a subject I will return to shortly. A key concept for analysis of an economic shock is the output gap, a valuable tool for monetary policymakers as we assess the economic conditions because it summarizes the strength of demand relative to supply. The output gap represents the relationship between the economy's actual output, typically measured by gross domestic product, or GDP, and an estimate of its potential output. When GDP is higher than potential output, the output gap is positive, and the economy is in a state of excess demand. In this case, employment tends to be above its maximum sustainable level, with upward pressure on inflation. Conversely, when GDP falls below potential output, the output gap is negative, and the economy is in a state of excess supply. During periods of negative output gaps, employment levels typically are below their maximum sustainable point, accompanied by downward pressure on inflation. Without shocks, monetary policy decisions would be consistent with GDP in line with its potential. This alignment would correspond to employment reaching its maximum sustainable level, with inflation stable at our 2% longer run objective. In practice, such conditions rarely occur. Often, economic shocks push GDP away from its potential. While conceptually distinct, supply and demand shocks are difficult to identify, especially in real time. Many economic events do not fall neatly into one category. They contain shocks that affect both demand and supply. Moreover, the persistence of shocks is highly uncertain, and even sophisticated forecasting techniques can struggle to resolve this uncertainty as an event unfolds. With these classifications as a backdrop, let me consider the implications of economic shocks for monetary policy formation. Our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. How we respond to economic events depends on whether shocks create tension between the two sides of our mandate. First, let's consider a shock that moves the output gap and inflation in the same direction. We may have a positive output gap with employment above its maximum sustainable level and inflation above 2%. Conversely, we may have a negative output gap, with employment below its maximum sustainable level and inflation below target. In both cases, our inflation and employment objectives are aligned. Therefore, policy actions can be taken to address one objective, also support the other. With a positive output gap, where we observe both overheating in the labor market and inflation exceeding our target, our policy response would typically involve raising interest rates to cool excess demand. The intent is to bring employment closer to its maximum sustainable level while addressing inflationary pressures. With a negative output gap, lowering interest rates can stimulate the economy, which simultaneously would help increase employment and raise inflation towards its target. Now consider a shock that pushes the output gap and inflation in opposite directions. Policy tightening addresses inflationary pressures, but possibly at the expense of employment. Easing does the reverse. Thus, we could face a trade-off where tightening helps price stability but hurts employment. Given this possible tension, how should I react as a monetary policymaker? The answer depends on the relative size of the economic cost arising from deviations in inflation and employment from their respective longer-run goals and the balance of risk on both sides of our dual mandate. If inflation expectations risk becoming unanchored, then a stronger reaction to the inflation side of our mandate may be warranted. Conversely, if inflationary pressures do not intensify and inflation expectations remain well anchored, it may be prudent to prioritize downside risks to output and employment. This response may be especially necessary if weakness in the labor market risks becoming entrenched. Another consideration is whether the shock is expected to be short-lived or persistent. Keeping in mind that monetary policy actions tend to work with a lag. This consideration is important when deciding whether to respond to a shock or to allow it to pass without a policy response. If a shock is expected to reverse before monetary policy can take effect, looking through it may be the appropriate approach. It is challenging, however, to predict how long a shock may last. The appropriate monetary policy response, again, requires weighting the risks to both sides of our mandate from various actions. When confronted with a single shock, policymakers must carefully identify and respond to that shock. Shocks, however, rarely happen in isolation, further complicating this task. Sometimes the economy faces multiple shocks simultaneously that may affect both supply and demand. Moreover, we face uncertainty about how shocks propagate through the economy. Such complications bring me to the challenges posed by the current juncture. Currently, I am monitoring two significant developments: the conflict in the Middle East and the proliferation of artificial intelligence. The Middle East conflict is, in part, a supply shock. Global supply chains for oil and other energy-intensive goods have come under stress. The resulting spike in the price of oil, shown in Figure 1, and related products has lowered real incomes and triggered a worsening of financial conditions more broadly. While oil prices have declined from the recent peak, considerable uncertainty remains in the region, which may still weigh on economic activity and inflation. This outcome has put modest downward pressure on aggregate demand. I expect the effects on demand to be muted, however, because the U.S. is now a net exporter of oil, and oil production and U.S. production is less oil intensive than in the past, as shown in Figure 2. As shown in the left panel of Figure 3, this supply shock is occurring in an environment in which inflation has already been above the FOMC's target for some time, in part a result of post-pandemic imbalances. At the same time, the unemployment rate, illustrated in the right panel of Figure 3, is near a level that most observers view as consistent with maximum employment. These factors confront the FOMC with a delicate balancing act. On the one hand, we face the imperative to address inflationary pressures. On the other hand, we must be mindful of employment potentially moving below its maximum sustainable level. This scenario exemplifies the type of policy dilemma where our dual mandate objectives are not aligned, but rather in tension with each other. Of course, this energy shock also overlaps with the shock stemming from a significant change to trade policy. Recent trade policy changes have had at least near-term effects on both output and prices. Those policy changes may alter the economy's productive capacity and have implications for the labor market. As a policymaker, I take all of these developments into account. We do not have the luxury of considering each shock in a vacuum. Instead, we must consider the whole economy when setting policy to achieve our dual mandate objectives. The quick succession of shocks raises the risk that inflation becomes entrenched and inflation expectations become unanchored. The question of whether the recent increase in energy prices will feed into longer-term inflation expectations and result in a persistent rise in inflation is a critical one. The second development I am monitoring is AI. Surveys of businesses, like the one illustrated in Figure 4, suggest that the uptake of AI has risen considerably over the past 2 years. This technology presents a fascinating case study from a policymaker's perspective, as the economic shock from AI is likely to have persistent effects on both supply and demand. On the supply side, AI will automate some workers' tasks and augment their ability to do others, which will likely lead to significant productivity gains. That development, in turn, would raise the growth rate of potential output over the coming years. On the demand side, optimism about AI may boost investment and consumption today, even before these productivity gains fully materialize. Firms expecting higher future profits are investing heavily in data centers, advanced computer equipment, and AI capabilities. Indeed, Figure 5 shows that firms' capital expenditures, likely related to AI, have increased substantially recently. The timing of the supply and demand effects is of crucial importance for monetary policy makers. If, on the one hand, the demand effects from stronger investment and consumption are realized sooner than the supply effects from productivity growth, AI could exert upward pressure on inflation. If, on the other hand, increased productivity lowers production costs sooner, we may observe downward pressure on inflation. A related consideration is the potential of AI on the longer run neutral rate of interest, often called R star. This is the real rate of interest consistent with the economy operating at its full potential once all shocks have dissipated. If AI leads to permanently higher levels of productivity growth, it may increase firms' desire to invest and hence their demand for funding. Higher productivity growth may also discourage household savings by increasing expected future income. Under these circumstances, to reconcile the increase in investment with reduced savings, R star would likely rise. However, predicting changes in the neutral rate is challenging, given that historically there's a noisy relationship between productivity growth and real interest rates. Furthermore, potential AI-induced increases in inequality could have a mitigating effect on R star. High-income households tend to save at higher rates than lower-income households. Thus, a rise in income inequality could lead to an increase in the supply of savings, putting downward pressure on the neutral rate. While R star, like potential output, is not directly observable, estimating it is of considerable importance for monetary policymakers because these estimates are informative about the range of interest rates that we consider broadly neutral. If AI indeed raises the neutral rate, then for any given level of the federal funds rate, policy effectively becomes more accommodative. Conversely, if AI-related developments cause R star to decline, policy effectively becomes more restrictive. Policymakers must remain attentive to developments to ensure that the stance of monetary policy remains appropriately calibrated to help the economy smoothly transition to a new equilibrium. Before closing, let me add a word about the current stance of monetary policy. I am fully committed to returning inflation to our 2% target, consistent with our dual mandated objectives of price stability and maximum employment given to us by the Congress. At our last meeting in June, the Federal Open Market Committee decided to maintain the target range for the federal funds rate at 3.5% to 3.25%. This policy stance should continue to support the labor market while allowing inflation to resume its decline towards our 2% target as the effects of past tariff and energy prices pass through completely. That said, in a scenario where actual inflation does not start to cool soon, I believe that it could be appropriate to reconsider our current policy stance to ensure we fulfill our commitment to deliver price stability. Fortunately, our current policy stance leaves us well positioned to respond to economic developments based on the incoming data, the evolving outlook, and the balance of risks. As I've emphasized today, understanding and responding to economic shocks as events unfold is challenging. Correctly identifying shocks as they occur and setting policy appropriately helps maintain well-anchored inflation expectations, which is crucial for monetary policy. When the public trusts that the Federal Open Market Committee will return inflation to our 2% longer run goal, policymakers have more flexibility to respond appropriately to the full range of shocks the economy might experience. The economy will continue to evolve. New shocks will occur, and policy responses will adapt accordingly. I think carefully about the shocks the economy faces and their implications, because this puts me as a policymaker in the best position to fulfill our mandate and to serve the American people. Thank you for inviting me to speak today. I look forward to our discussion.
Thank you for those wonderful sweeping remarks. I understand why you're such a well-regarded teacher, and also why your classes were not the easiest. You covered a lot of ground. So I want to start by probing a little bit on a topic that you mentioned at multiple points in your remarks, which is inflation expectations. We had a bout of inflation coming out of the pandemic. We've seen increased inflation now due to rising energy prices. Some people have talked about how there's a greater risk of higher inflation expectations becoming entrenched now that we're sort of at our second shock. What are the measures that you are tracking? We have market-based inflation expectations, survey-based inflation expectations, other measures as well. What are the measures you're tracking? How do you digest all of this information to help inform your policymaking decisions?
Well, thank you for that question. And the short answer is that we track all of the above and more, okay? In that we do look at market-based measures. We do extensive surveys of firms and households. We look at those measures. We also gather qualitative information that is often reported in the Beige Book, which comes out regularly. And we each do a lot of outreach in between meetings where we talk to businesses and ask them about what they're experiencing, how they're thinking about pricing pressure, how sensitive their consumers are to potential price changes. And so we have different statistical measures in-house. We look at what's happening in terms of the short, intermediate, and long term. So what's very important for me in terms of my thinking about the outlook for the economy and the confidence that Americans have in the Fed is to look at longer term inflation expectations, okay? I believe that we see in the data that short run inflation expectations are much more sensitive to things that are happening right now. But even over the episodes that you mentioned introducing this question, longer term inflation expectations have stayed anchored relative to our 2% target. So not far from that target at all. So what that says to me is that the American people believe that we are credible in our commitment to returning inflation back to 2%. And that anchored ring of inflation expectations, as I said in my remarks, really does give us more flexibility to respond to the shocks that hit the economy.
And these are both the tips-based, sort of five-year,
Yes,
2-year, 2,
exactly.
and the survey-based.
Exactly. The longer-term survey-based ones are anchored, certainly relative to what we see in the short term. Those are more, they fluctuate more.
So I had some questions prepared on AI and the productivity and inflation implications. But I thought the framework that you presented, connecting the supply and demand shocks to the short run impact of AI being a demand shock and the long run being a negative supply shock, was illuminating and answered
or
all my
positive
questions.
supply shock. I mean,
Positive supply shock.
right?
Yeah, that's
negative impact on inflation.
Negative impact, exactly. I thought that was illuminating and answered my question.
Okay, good.
Oh, we can skip, but I think we are going to be soliciting questions
Okay.
from the audience. So let me actually move on to the labor market, and let me start by asking you how you would characterize the labor market today. I think you've previously talked about a break-even pace, the number of new jobs that the labor market needs to create to keep the unemployment rate constant at around 70,000 per month. We've obviously had ups and downs. We want to follow the trend. Not every data point. I think we came in at 57 in the previous job mark. I think you have and many others have talked about a low fire job market. So maybe big question that we can probe. How do you characterize the labor market? Where are the strengths? Where are the areas of weakness?
Right. So I would say, broadly speaking, that the labor market is stabilizing. So since the summer of last year, if you look at the monthly data, we've bumped around somewhere between 4.2 and 4.4%. So we're just sort of going along sideways, and that range of unemployment is consistent with many estimates of what the sort of natural rate of unemployment is for the economy. And by that, I mean the rate of unemployment where the labor market is not a significant source of inflationary pressure, okay? Now, what's also true is that we've had this low fire, low hire labor market also. So in that sense, the labor market is not as dynamic as it has been in the past. Firms are very conservative about bringing on new workers, but at the same time, they're not letting a lot of workers go. So there is this element when we do our outreach, when I do my outreach and talk to firms, where they're kind of waiting to see, how things are going to develop. They're dealing with a lot of uncertainty in terms of macroeconomic policy, and they are waiting to see how the implementation of artificial intelligence in their sectors will play out over time. So that's my sense right now, is that if you look at the aggregate numbers, it looks okay, but I think we all would welcome some more dynamism, but we certainly don't need to see, or I don't feel as though we need to see any more increase in unemployment.
So let me focus on one area where I think the let's call it lack of dynamism is more acute, which is job opportunities for new college graduates. We've seen higher unemployment rates. We've seen anxiety among our graduating students, and there's a host of theories that have been proposed, from work from home to AI to the uncertainty and cyclical factors which are leading firms to slow down hiring young college graduates. How are you thinking about that segment of the labor market? What advice would you have to some of the young folks who are going to be on that labor market soon, if not are already searching for jobs?
Well, first, let me validate that what you're raising, we do see that in the data in terms of the some weakness in the labor market in terms of young people's employment. So I never want to downplay that. That's very, very real. I do want to emphasize, though, that there is not necessarily a role for monetary policy in terms of targeting that segment of the labor market. We really have to focus on what's happening in the aggregate with respect to that. So in terms of what monetary policy can do, there's not a specific remedy for one particular segment. Now, and this is emblematic of the national unemployment rate being an average of the unemployment rates for many different type of demographic groups, okay, all of which are very, very important. But, with respect to, and now let me say that I'm outside of my role as a policymaker when I think about, what advice to give young people who are going into the labor market. So let me say that I don't have any expertise here. Okay, there's probably people in here in this room who study labor markets.
And your students have done very well.
Well, okay, right. Well, that's a credit to them. Okay, and so I want to acknowledge their excellence in that regard. But I think it's important. So for instance, I can say what I've said to my sons, because I have young people in my family who are out there in the world, and the idea that I've stressed is always to do your very best while you're in school, gain the skills that you you sort of naturally gravitate towards. And then with respect to when you go on to the market, I think it's important to be very flexible with regards to geography. It can be helpful to sort of being flexible to move to where the opportunities are, wherever they may be. We have a big economy. Now, all of what I just said has nothing to do with me being a monetary policy maker. And so I always want to emphasize that in a setting like this, and with respect to my remarks, I'm speaking only for myself, not the Federal Reserve Board, not the Federal Reserve System, okay? And particularly that line of commentary was specific to me.
So maybe I should take some of the questions from the audience, and we're using some new technology, so it's a live test of whether. This is a great question. For some of this, so you've spent many years as a researcher, and you're now on the receiving side of research and all the information gathering in the economy. From the perspective you have now, and for the young researchers in the room, what do you think are important unexplored questions in monetary policy? Places that would be particularly valuable to people who sit in the rooms that you sit in?
Well, that is a great question. And so again, for myself, what what we see in the data is that short-run inflationary expectations move frequently. And what I think we don't understand fully is the relationship between short-run inflationary expectations and longer-term inflationary expectations. And so that is something that we care a lot about. Also, measures of consumer sentiment used to map pretty well into actual consumption behavior. But what we're seeing now is that on surveys, households will complain like crazy about their situation, their family situation, the regions, and they go out and spend, okay? And so consumer sentiment surveys appear to be, in the current moment, disconnected from actual behavior. And that was not always the case. Okay, so a question is sort of what has changed around that. So that's something that I personally would like to understand better. What would be another one that comes to mind? Well, a lot of research is done, but what we don't know on this particular topic, and I mentioned it in my remarks, is this issue of the equilibrium real interest rate. You know, I know a lot of work has been done on that, but I still think there's a lot for us to learn. And the reason that is so important is because here's a very simple question that's actually hard to answer. And that is policy currently restrictive, right? So what is the stance of policy now, or at any particular point? It's a restrictive policy means that you are sort of leaning against the wind a little bit and policy is sort of moderating economic activity, versus if it's accommodative, it's encouraging more economic activity. So knowing more about the neutral rate and where it is, that could be helpful also. So those are just three off the top of my head.
Those are great questions. Certainly not ones that we can answer on the fly, but a good topic
Yes.
for a dissertation. Long-term and short-term federal budget seems to put upward pressure on inflation. How do you think about the fiscal trajectory from your position in the Fed?
Well, first of all, let me say that fiscal policy is the province of elected officials. And so as a monetary policy maker, I take fiscal policy and trade policy as given, okay? In terms of my thought process and the monetary policy making process, I take that as given and say conditional on what elected officials have decided to do, what is the appropriate monetary policy? So what I'm focused on is not the policy itself, but the economic implications of the policy for how it's going to play out on our mandated goals of price stability and maximum employment. And once I come up with a hypothesis for that, along with all of the other considerations that we must weigh, then that helps me to think about what I think the appropriate path of policy is.
So here's slightly different lane. As the economy digitizes, there are already, and there may be further challenges to measuring GDP. How do you, as a Fed policymaker, think about those measurement issues with GDP and productivity?
Well, that is a great question. So first, this gives me...
This is basically people in Silicon Valley saying, we want more credit for all the good we're doing.
Exactly. So this gives me an opportunity to mention the task forces that our new chairman has developed and is currently enacting. One of them will be on data. And I think that that's going to be very important because as the economy becomes more digitized, we can ask ourselves, how do we need to change the data that is a critical input into monetary policymaking? We need to make sure that we're receiving the right kind of information, and that may be new information that maybe wasn't available 10 years ago based on the digitization of the economy. Now, with respect to how that digitization is going to impact the structure of the economy, there's going to be another task force on productivity, for instance. And I can imagine that right now that we are going through a period of potentially of structural change. And so we need to understand as a policymaker, it is critical for a monetary policymaker, it is critical that I have some conception between cyclical variation in the economy and fundamental structural change. Because there's very little that monetary policy can do about addressing issues, changes in the economy that are structural. So I wouldn't want policy trying to impact that. But things that are cyclical, then that's something that I would want to be much more attentive to. So the digitization of the economy is just a part of all of the changes that are going on right now that I and other policymakers need to be mindful of.
Great. So what I'm going to do is try and batch some of the questions,
Okay.
given that we're running out of time, and ask provide you some opportunities to touch on. I think that things that multiple people are interested in. So one is stablecoins, crypto. How do you see these technologies fitting into the U.S. financial system, both in terms of the dual mandate, in terms of opportunities and risks in the system? Maybe if you could speak just with your perspective to that evolving part of of how we buy and sell.
Okay, so to that, I would say that the current wave of financial innovation that these new technologies represent is part of a long tradition of financial innovation in the U.S. economy. Okay, so in that regard, they're not new in the sense that the financial system has always adapted and adjusted. Okay, our role at the Fed is to help ensure the safety and soundness of banks. Okay, that's part of our mandate also. And that's what we will continue to do. So we never want to get in the way of innovation. That's not our job. The private sector should absolutely continue to do what it does. And our role is to make sure that banks, as they're interacting with these new technologies, as they are formulating new payment rails, that they are responsibly gauging the risks associated with these new technologies. So our job is to make sure that they know that we are watching them to make sure that they're taking into account all of the risks associated with these new technologies. Now, another part of your question had to do with the possible impact of these new technologies on aspects of our dual mandate. One way of thinking about them is that the American people or people who participate in the economy will continue. Evidently, they welcome these new ways of paying for things in terms of efficiency, and we have to assume that it's improving their lives, okay? So we don't want to discourage that either. And whether or not any of these new technologies in and of themselves will be inflationary, I'm not aware of a channel or mechanism by which that would be the case. So, and then in terms of employment, it could be that, with respect to new technologies, new jobs are created and that we haven't necessarily imagined. So I think only time will tell if it has any impact on the employment side. So it's early days, too soon to say. I'm not at this moment concerned about macroeconomic performance issues around it. And then on the financial stability side, we are interacting quite a bit with the banks to make sure they are keeping account of all relevant risks.
One last question. So here at Stanford, when I was a grad student here, I took third quarter macro from John Taylor, which had the obligatory healthy dose of the Taylor rule. Sitting where you sit, how do you think about and use the Taylor rule? I don't know if John is here.
Right. Well, every FOMC meeting, first let me say I think the Taylor rule is a fundamental contribution to the science of monetary policy. Okay, there's no doubt about that. It just provides us with a systematic way of thinking about setting our policy rate. You will notice that in my remarks, I really emphasize the output gap, and that's one of the components to the Taylor rule. So, okay, that was a nice commentary, to the Taylor rule. So, and in terms of the information that I receive prior to every FOMC meeting, there is a section with a wide variety of specifications of the Taylor rule that me and every policymaker receives. So it is pretty fundamental to how we think about it. How I think about it. Now, it's not the case that it's determinative for me in terms of how I might decide to vote over time on a policy issue, but it is useful to know what would be the prediction of a Taylor rule at the current juncture. And then it's another way of calibrating how I, as a policymaker, am thinking about setting the policy rate. So fundamental contribution that I hope one day will be recognized appropriately.
Thank you so much for joining us. How about a warm round of applause? Vice Chair Jefferson.
Thank you so much. My pleasure.